So you're thinking of buying or investing in a home in Denver, Colorado, and you hear all the realtors tell you about the tax benefits of investing. Well, in this video, we're gonna go over the truth, the lie, and also at the very end, I'm gonna tell you about a loophole that it's literally can save you thousands of dollars. And we're gonna get to it right now. What's up everybody, this is Angel and I'm a real estate agent over here in Denver, Colorado. And first of all, I want to thank this user for sending me a comment. Here's the comment and it says, "Thanks for the video. It would be interesting to hear more about your experience with homeowners and landlords in regards to actual tax savings versus perceived through owning real estate." And I'm just gonna say thank you so much for your comment. That's why I created this video. There is a lot to unpack, but first let me tell you very briefly about my background. Before I started working in real estate, I actually got an accounting degree. I actually used to do tax returns. I probably did over 600 tax returns. So when I'm talking about these topics, I'm talking about from the actual perspective, not the theoretical perspective. But I will say I'm no longer doing tax returns, but I do have a way better understanding than most realtors because I actually got to see it in action. And although I'm a CPA at the moment, this is no tax advice because there are certain situations that you have to apply each single step perfectly so that you can get the tax break. So for that, you're gonna have to need a private consultation with an actual CPA that specializes in that. So first of all, we're gonna talk about the three different types of investing. There's others, but we're gonna focus on the three main ones that most people hear about. So the first one's gonna be home ownership. So this is when you buy a home for living in your property. What are the tax advantages of living in that property, buying that home? A lot of realtors, they're gonna tell you, you buy a home, you're gonna get a tax break. And I'm just gonna say it, this is for most people 100% false. I would say that only about 5 to 10% of the people actually get this tax deduction. And let me explain this really quickly why. Basically, just for living, the government's gonna give you an automatic, no questions asked deduction for $25,900 for the year. So you can either do an itemized deduction, which is gonna list all of the items that are allowable for getting a tax deduction, or you can get the tax deduction. But of course, you have to choose. Do you want a standard deduction or do you want the itemized deduction? And the thing is, of course, you wanna take the highest deduction. Now, what that means is your itemized deduction must be higher than $25,900 if you're married filing jointly so that you get a greater tax benefit. So now let's give a real life example. If you have a house that's valued at $600,000 over here in Colorado, the average property tax is about 0.5%. So what that means is that you would be paying about $3,000 in property taxes. Other allowable deductions are going to be your interest. Of course, this is going to depend because, of course, you could be having a $1 million loan or you could be having a $500,000 loan. But just in general, we're already starting at a point of $3,000. For us to make it to almost $26,000, there's gotta be about $23,000 in other deductions that you can take, including interest, including charitable deductions, which there's limitations for that, including medical expenses, as long as they're over 7.5% of your income. And all of that is to say that most people are not gonna reach the threshold necessary to have a higher itemized deduction as opposed to the standard deduction. And because of that, when people are telling you, hey, you're gonna get a tax break because you own a home, that's why you won't, because it's typically gonna be lower than the standard deduction. Of course, there are circumstances where you can meet that threshold, but really the actual tax benefit, it's gonna be the difference between the standard deduction and the itemized deduction. So let's just say that you did have, let's say $30,000 in itemized deduction expenses. Now you would have gotten a $26,000 deduction. So your actual difference, your actual tax benefit is $4,000. And let's say you're in the 30% tax bracket, you're gonna save about $1,200 a year. And all that to say it's $100 a month. I would say if you wanna buy a home, to save $100 a month in your taxes, it's probably not a good idea. Now, of course, I'm not discouraging you. And if you look at my original video, you will see why over the long term, typically homeownership is going to be a better way to go. But that's not to say the reason to buy it is for the tax benefits. And I just want to say, send me your questions. I'm always happy to help. Just like I'm making this video, I could make a video about answering your question about buying a home in Denver, Colorado, or moving to Denver, Colorado. Drop a comment down below. Now, we just talked about the yearly annual benefit of owning a home, but now let's talk about when you sell your home. And here you actually get a huge tax benefit. In general, if you live in your home for at least 2 out of the last 5 years, what that means is that you can exclude gains on the sale of your property for up to $500,000 if you're married filing jointly. If you're single, it's going to be half, $250,000. And now let's jump into an example. Let's assume back in 2013, you bought the house, you timed the market perfectly, and you bought a home over here in Denver for $200,000, which at that time it was possible. Now the median price right now is about $570,000, and assuming you didn't make any capital improvements, you didn't put a new kitchen, you didn't put a new roof, no new bathrooms, you bought the house, you just used it, and now at the end of 10 years, you're selling it. Of course, there is cost of selling, and that's gonna include the agent's title and other costs. And let's just round it to $40,000. Now you made a gain of $330,000. Now you just made $330,000. If you're married and you're filing jointly, this is gonna be 100% tax-free, and this is what I like to hear. Now, if you're single, the first $250,000 is gonna be tax-free, and you're gonna pay taxes over $80,000. And guess what? These taxes are gonna have a preferential tax rate. So you're either gonna pay 0%, 15%, or 20% of that. And worst case scenario, you're gonna pay 20%, and that's gonna be $16,000 for the federal. And for Colorado, let's just assume $4,000. So in total, you're gonna pay a total of $20,000 for taxes. So now one thing to note is that the gain calculation has nothing to do with the mortgage. So let me just walk you through an example, how much taxes you would actually pay versus how much money you would have gotten. So you bought your house in 2013 for $200,000, assuming you put down 10%, then your note is going to be for $180,000. Interest rates in 2013, 10 years ago, it was about 4%. And of course, you made 10 years of payment. So your note is actually now $141,000. And I'm assuming there is no additional payments and no refinance. Now at this point, you sell your home for $570,000. You pay the remaining mortgage balance of $141,000. You pay closing costs, the realtors, everything. That's going to be $40,000. And you're going to pay, again, $16,000 for federal income taxes and $4,000 for Colorado. And again, we're assuming the worst case scenario, you're going to get a check for $369,000. So you're actually going to be paying about 5.4% out of the money you receive. And this is something that's incredible because you could have a 20% tax rate, but the actual tax that you're paying, it's going to be 5.4%. That has to do with the exclusion. And again, this is the worst of the worst case scenarios. But remember, married people, they don't have to worry about this because their exclusion is $500,000. So an alternative tax planning strategy that you could use, you could just get married the year you're gonna sell the house, you can get the exclusion and then sell it. And here's what I tell everyone, you don't even have to pay the $20,000 in taxes because you could just keep the house as a rental. There's so many options. You can, if you need the money for a down payment on another home, you use that HELOC to put the money down on the next property. You can refinance and get cash out. As long as the property is cash flowing, that could become your next rental, which is one of the investing strategies. It's basically you buy a home, you have all of the benefits of using your home as a primary residence. You get a lot of breaks when it comes to your mortgage. You don't have to put 20% down. But now, instead of selling it, you can just buy a new one. use the old property to leverage the new buy. And now investors are going to get a lot of tax benefits. We're going to talk about that later in the video. But before we talk about rentals, now let me tell you about one very unique investing strategy. This is called the live and flip strategy. Now, because of the tax benefits I just mentioned, imagine that you buy a home that you're gonna live in it yourself. Again, you gotta live in there 2 out of the last 5 years. You can buy a fixer-upper. You can push a ton of appreciation into the house or forced appreciation. You're gonna remodel it. You're gonna get a new kitchen, new bathrooms, new roof. If you're handy and you can do it yourself, you're even gonna make way more money because of course you don't have to have that cost of paying other people to do it, and you're gonna be living in the property. And let me just tell you how powerful this strategy is. I did the taxes for a couple. They were in their early 20s. I think they were like 22. And the taxpayer, he was very handy. He basically did construction for a living, and what he did, he just bought a fixer-upper. He was living with his wife, and he remodeled the property himself. And then at the end, when he came in to do their taxes with me, and by the way, at the time, I did not know him. He just kind of came in and I took care of him. He was so concerned about how much taxes he was going to pay because he actually had over $100,000 gain. And now what happens is he actually got to sell the house 2 weeks after the 2-year anniversary, and he was living in it. He fixed it himself, and he sold it exactly 2 weeks after the 2-year anniversary of him living there. And what happened is he got $100,000 gain, 100% tax-free. This is just an amazing strategy. Imagine just getting $100,000 with no taxes. It's just incredible. This is just a powerful situation that you can utilize this strategy, use the tax code, and make more money. And now, once he knew that, now just rinse and repeat. Buy a house. He buys a house every 2 or 3 years, and then he fixes them himself, and then he sells them. This is the live and flip strategy, and this could be a good way of, instead of going the fix and flip route, you can use the live and flip strategy. Of course, it's not for everybody, but it could have tremendous tax benefits. And these are some of the things where the tax code can be very sneaky. And if he had sold just a month before or 2 months before, he would have paid a ton of money in taxes. And that's why you're watching this video, because you want to save thousands of dollars when you're buying homes in Denver, Colorado. I just want to take a second to say I'm a real estate agent, and if you're thinking of moving to Denver, Colorado or the surrounding areas, make sure you reach out for a private one-on-one conversation where we're going to talk about what you like and especially what you don't like, so that we can narrow down your search and find you the perfect place. All of the information's in the description below. Now back to the video. And this could be a good transition into talking about the next investment strategy, which is going to be the fix and flip strategy. Of course, this HGTV, it makes it super popular. You buy a property that's just in terrible condition, you fix it up, it's beautiful, and then you sell it and make a ton of money. Of course, it's super easy. There is nothing you have to worry about. Just go and do it. Don't even read a book. Of course, I'm kidding. There is a lot that you gotta know before you start doing this, especially about having a team, but I'm not gonna get into that right now. Let's talk about the tax situation. What happens with taxes is that when you're fixing and flipping a property, the IRS actually considers that the same way they consider selling anything else. If you sell water bottles, it has the same treatment as selling fix and flip homes as it relates to manufacturing. So you actually have inventory. And this is something that when I just learned about this, it was a little hard to wrap my head around it, because it's like, it's not a house. This is not inventory. But when I think through it, it kind of makes sense at the end. It's just manufacturing something. And that's what the IRS position is. And what this means is that fixing and flipping is actually an active income category. What this means is whenever you make money, you're gonna pay self-employment taxes, which are gonna be about 15% of the total income. And this is something that a lot of flippers miss. So let's say you do a fix and flip, not live and flip, because live and flip does not apply with this. That's one of the other benefits about live and flip. But anyways, you make $50,000, you're gonna pay your income tax. Of course, there's other variables for that, but just self-employment taxes, you're gonna pay $7,500 in self-employment taxes. Whereas this doesn't even include how much you would pay with income taxes, which if you're in the 15% tax bracket, which I think it's actually gone, I think it's 12 right now, but let's just say 15, then it's another $7,500. So you made $50,000 after you bought the home, you coordinated the contractor, you had all the struggles with selling the property, managing the agents, managing everything. It's a lot of work to flip a home, and I've flipped a few, and I can tell you it's just a lot of coordination, and you can lose money really easily, especially if you're using a hard money loan, but we can get into that later. And so you make $50,000, you're gonna pay $15,000 just in taxes, assuming 15% income tax, 15% self-employment tax. So you actually ended up making 35. This is not the way I like to make money. I like to make money tax-free. I would rather use the first strategy, but of course, everybody has different objectives. And one thing I would say, a lot of people say, you'll hear people say that flipping homes, it's just another job. And what I'll tell you is that the IRS treats it the same way. Flipping a home, it's just another job. Now, the good thing is that because it's active income, if you have losses, you can actually apply those losses towards your active income. So let's just say you're a high earner. You make $200,000 a year. If you're interested in dipping your feet into fix and flip, there is very little risk in terms that if you make money, yes, you're going to pay a ton of taxes, but of course, you knew that that comes with it. But if you lose money, you actually get a tax break. So it can offset your active income, and instead of losing $10,000, you actually lost $7,000. And of course, I'm just throwing numbers around, but it just lowers your risk because you can take that deduction against your active income. Now let's talk about another one of my favorite strategies. This is gonna be the buy and hold strategy. Of course, like it sounds, you buy a property and you're gonna hold it. And I'm just gonna first introduce some accounting concepts, because before we talk about the actual benefits, you got to understand these concepts. And just so you know, this is where a lot of people can make a ton of mistakes that it's going to cost them thousands of dollars. So first, let's talk about depreciation. Well, in real estate, you typically hear appreciation. You're going to make money with appreciation. And what that means is the value of your property going up. But for taxes, depreciation actually means that you get to take a deduction in the cost of your property, even if your property is going up in value. Let me say this again. This is the most beautiful thing about investing in real estate. Your property could go up in value, but you're still gonna get a deduction in your tax return. You're gonna get a paper loss. This is just the thing that you want. This is what we want. This is what we all want. So now typically, and I say typically because there's exceptions for everything, your property is going to be depreciated over 27 and a half years. And these are going to be single family homes. And the depreciation is calculated on the cost of buying the property plus the capital improvements that you made, like upgrading a kitchen or a new roof, less the amount of the value of the land. So you're not depreciating land. Now, let me give you an example. Let's say you bought a home for $600,000. The value of the house is $200,000. Now, your depreciable basis, it's going to be $400,000. And now, calculating depreciation, it can get a little tricky with the 27 and a half years. You actually have to tell the IRS which month you actually started putting your property for rent. For the purposes of this video, we're going to keep it very simple. The first year, I don't know why Congress makes this so complicated, but basically the first year, we're just going to assume we started placing the property for rent in January. We use a mid-month convention, which that means that you can put it for rent on January 31st and you're still going to have depreciation from January 15th, but then the other applies as well. You can have put it for rent on January 1st, but your depreciation is going to start January 15th. So the first year, we're going to have 12 and a half months for depreciation. In this instance, we're going to have a $400,000 depreciable basis, and it's going to be on the first year depreciated for 11 and a half months. So for the first year, you're gonna get a tax deduction of $13,940. And what this means is that if you have net income of $14,000, which would mean you rented the property, you deducted all other costs, maintenance, insurance, property taxes, etc., you actually ended up making $14,000 after all expenses. Then you take the depreciation write-off. Well, that means you actually made $14,000. The amount that you're being taxed on is $60. And let's say you're in the 22% tax bracket, you actually end up paying $13. And now, if you ask me to pay $13 in taxes for $14,000 income, that's just as good as it's gonna get. This is a tax rate of 0.09% of your income. And this is how you save thousands of dollars. Now, if you actually, instead of making $14,000, you make $13,000 in net income before depreciation, you apply depreciation, you actually made those $13,000 100% tax-free. Now, what happens with the amount of the depreciation that you didn't use? My income was lower than my depreciation. So what happens with that difference? And we're gonna get into that later in the video. Now, depreciation is a beautiful thing, but let me tell you about what nobody tells you with regards to depreciation. There is this concept called the depreciation recapture. And what this means is that every single year you operated the property as a rental, you took depreciation. And now when you sell it, you gotta pay that depreciation back at a 25% tax rate. And this is already messed up, because maybe when the years where you were taking the depreciation, maybe you were taking it at 12%. Your tax rate was 12%, so that was your benefit. Maybe it was 22%, but when you pay it back, it's gotta be at 25%. Now, if you're a higher income earner, it's the opposite. Maybe you took the depreciation at 33%, but now when you pay it back, you actually pay it at 25. So it could go either way. And now this is what nobody tells you, but now let me tell you how devastating this could be if you don't know how to navigate the tax code. So first, let's go back to that example before. We had a depreciable basis of $40,000. Year one depreciation was $13,940, and every year after that was $14,546. And we're gonna assume that you hold the property for 10 years. So the total depreciation that you took over the 10 years, it's going to be $144,854. Now you just decide, hey, I don't want this rental, it's too many problems. You just want to cash out. And we're going to assume you didn't make any capital improvements, again, just to keep this simple for purposes of illustrating the concept. So you didn't add a new kitchen, new bathrooms, new roof. Just, you bought the property, you rented it out for 10 years, exactly 10 years, and you didn't improve it over that time. Now, let's assume in that 10-year period, you actually have some real appreciation. Your property went up in value because all of the properties in Colorado went up in value in that period. Now, let's assume a 3% rate every year, compounded. So now the value of your property is actually $806,350. You're gonna pay about 7% for closing costs, the realtor's title, etc. So you're gonna end up paying for selling costs $56,500. And I'm just rounding up, of course. And again, the gain calculation has nothing to do with the mortgage. So you're gonna sell your house for $806,350. You paid $56,500 to get rid of it. Your original cost was $600,000, but you already depreciated $144,854. So now your adjusted cost basis is $455,146. And because of this, your total gain is going to be $294,704. And there is two types of gain here. The first type of gain is because you recaptured the depreciation that you took. So it's going to be $144,854. And the other gain, it's going to be because the house actually went up in value, and that's going to be $149,850. Now for the depreciation gain, you're actually going to pay 25% on that money, and that's going to be about $36,000. For the appreciation portion, the $149,000, you actually get a tax break. This is gonna be taxed at capital gains tax rates. And what this means, you either pay 0%, 15%, or 20%. Most people are either going to pay 0% or 15%. Just to give you an example, if you're single and you think you can be bumped to 20% long-term capital gains tax rate, you actually have to make a little over $500,000. But of course, a lot of people are in that tax bracket. For purposes of this, we're going to assume that you're going to pay the 15% tax rate, and that's going to be about $22,000 in taxes. Then you're going to pay Colorado, and Colorado has their own intricacies. If the property was built before a certain year, or if you bought it before like 1995, I can't remember the year exactly. We don't want to get into that. Let's just apply the flat tax rate that we have over here, 4.4%. So you're going to pay about $13,000 for Colorado for income taxes as it relates to selling that property. So just to recap, you pay $36,000 for a depreciation recapture tax, $22,500 for the federal income tax, and $13,000 for the state income tax. Now your total taxes were about $71,500. Of course, this is a lot of money, but don't get me wrong, even with this worst case scenario where you pay all the taxes, you're actually gonna come up with the check of about $342,925. And this is assuming you put 20% down at 6.5% when you bought the house. And still, this is a lot of money. Now let's talk about how you can avoid paying this money. You can avoid paying for all of these taxes by using the 1031 exchange. And this can be a video all in its own. There is so many intricacies. This has to be executed perfectly for it to work, because if you do something wrong, you can end up paying the $70,000 tax bill, and you really want to avoid that. Now, what the 1031 exchange allows you to do is actually defer the gain into a future period. Again, there is a lot of rules, you gotta follow them perfectly, but basically you would sell your current property and you would use the proceeds from that property for purchasing another investment property. And one of the hidden advantages of this that a lot of people don't talk about is that if you had sold the property and you pay the taxes and then buy an investment, you probably wanted to get rid of the rental and just retire, not have to worry about anything, then you would have lost $70,000. But if you exchange it, you're actually leveraging that money that you would otherwise have paid the government. So in that instance, you're investing money that's no longer yours. And again, this is another thing that just not a lot of people talk about this. And again, you really do want to work with someone who really understands the intricacies of that, because if you do it wrong, you can really lose a ton of money. There is no limit as to how many exchanges you can do as long as you keep following the rules. And I'm just going to throw this in there. If you're a tire landlord and you want to sell your investment property, you hold it for 50 years, you don't even have depreciation anymore. Now, in these instances, what you can do, there's something called I think it's like a Delaware trust. They call it DST. And basically, it allows you to invest into passive vehicle, whereas you have a manager that's managing the properties. They're typically commercial multifamily properties, but it still counts towards the ability to 1031 exchange your gains into that kind of trust, because it does not apply to all kinds of investments. It's got to be very specific investments that were made in specific ways. And typically they're not going to have as high rates of return as if you would to invest it yourself, of course, assuming that you know how to run these properties. But what it does allow you to do is just get mailbox money. If you want to retire, you don't want to worry about tenants, you don't want to worry about the toilet and the downsides of landlording, which of course there are many. Then you can put your money into these trusts and you're just going to get a check every month. We're introducing these concepts because I'm going to tell you later in the video how these apply to both short-term rentals and long-term rentals. But I just want to talk about the next concept, which is the stepped up basis. You might have heard the quote from Benjamin Franklin that he said, "In this world, nothing is certain but death and taxes." And he's 100% right. We're all going to have that ultimate thing that's going to occur to us. We're all going to die at some point. It's just a fact of life, unfortunately. Now with this, there's gonna be some tax planning that you could do so that you can save your descendants a ton of money. And this is where the concept of stepped up basis come in. Remember the example I talked about before? The property was valued at $806,350 and the adjusted basis for you was $455,146. Now let's assume that you're already the surviving spouse and you're gonna leave this to your descendants. Same situation, it just occurred at the very end of year 10. What happens is when your descendants inherit the property, even if you used the 1031 exchange before, they're gonna inherit it. Their basis is gonna be the value of the property at the time of death. So in this very same example we've been working on, where you were gonna pay $70,000 in taxes, but you 1031 exchanged it, if they inherit that, they're gonna get the new property at the new value at the time of death. You literally just save them over $70,000 in taxes. And not only that, but that's a new basis. And so if they want to keep the property as a rental, now their depreciation is going to be so much higher just because their basis is higher. So they're going to have even more paper losses. The 27.5 years are going to reset. So they get another 30 years on depreciation. Let's assume that you bought the house 30 years ago. Now you depreciate it for 27.5 years. You no longer get these paper depreciation. You no longer get the paper losses, but now you leave it to your descendants, and now your descendants get to depreciate the property over the next 30 years. This is another powerful strategy, and that's why a lot of people, they become millionaires with real estate, because you just get a ton of these little things that over time and compounded, they just make huge differences over investing in other methods like the stock market. And I'm gonna tell you, you gotta do it right, because this is another one of the things where, let's say you gifted them the property, you signed the title over to them whenever you were still alive. Well, in that instance, they will not get the stepped up basis. You might even pay a gift tax because you're gifting that property. So you really got to do this right, because you want them to inherit it the right way so that they get the stepped up basis. Now there's methods of having your survival spouse have this stepped up basis as well. There is a lot of rules and intricacies about that, and really I'm just illustrating the concept, so we're not going to get into that in this video. And for that, honestly, you just got to reach out to estate planning lawyer. I have some referrals I can give you. But in any case, what this opens up is the possibility of what some people call the swap and drop strategy, which basically means, I know it sounds a little bit draconian, but it basically means you're gonna keep exchanging properties. You're gonna keep deferring the gains from one property to the other. You can buy land first, then you have a single family home, then you buy a duplex, and then you buy a 5-unit apartment, and then a 20-unit apartment. Of course, over time, you keep deferring that gain, and then at the end, your descendants can inherit that 20-unit apartment with the stepped up basis and get to do it all over again. This is called the swap and drop strategy. Now, I want to introduce this other concept called the real estate professional, and for this, you gotta perform over 50% of your services in the real estate industry and also work at a minimum 750 hours for the year. Now, there is two things to unpack with this definition. The first one is gonna be the 50% of services. More likely than not, if you have a full-time W-2 job, you're probably not gonna qualify, because basically, if you're a full-time employee, you're already working about 2,000 hours. So what you're saying is you're working 2,000 hours in a year in your job, but you gotta work more than 50% on real estate. So that's gonna be 2,001 hours. And it's gonna be very unlikely that the IRS believes that you're working 80 hours a week, and 40 hours are your job and 40 hours in real estate. So typically, once you have a full-time job, you won't qualify as a real estate professional. And the second part is what qualifies as a real estate professional job, and this is a very broad definition. You could be in development or construction or rentals, or you could be leasing, and all of those professions actually qualify you as a real estate professional. And one of the good things about this is that this could be met by one spouse. So if you're a high income earner and your spouse is a homemaker, then you can ask your spouse very nicely, of course, like, hey honey, like, hey, we gotta get you to work 750 hours in a year so that we can qualify for this. And of course, all of that in real estate. And for your spouse, then would work for about 750 hours, 100% in real estate, and it would meet this requirement. Now, let's talk about the next requirement, which is going to be the material participation. There's 7 tests, and these are very specific as to how to qualify for material participation. Most people are going to fall into material participation for 2 of these 7 reasons. The first one is, and this could apply to both the spouse or yourself, and one of the spouses could qualify for real estate professional, but both spouses could qualify for material participation. This one doesn't have the other layer of the 50%. So just one thing to know. But the 2 that are most likely to qualify you for material participation are: the taxpayer participates in the activity for more than 500 hours during the year, or 2, the taxpayer does substantially all of the work in the activity. And of course, the first one's very self-explanatory. If you work 500 hours or more across your rentals, you could qualify for this. And this is not investor level work. This is going to the property, swinging the hammer, putting new leases, putting new tenants in, showing the home, actually doing the work necessary to run the business. Or number 2, the taxpayer does substantially all of the work in the property. And what this means, if you're self-managing, if you're getting tenants, even if you're not meeting 500 hours in the year, you could still qualify for material participation. Now, I know this has been the longest section. It's just that for us to truly talk about and do a deep dive as to the benefits, you gotta understand those concepts. Feel free to go back and rewind so that you can really understand what I just said. Now, let's talk about how these concepts apply, and this is where you're gonna actually get to use that information I just talked about. Let's talk about long-term rentals. For long-term rentals, you're gonna get the deductions for costs that you incurred in running the property. So property taxes, insurance, maintenance, interest, and all of the costs that are necessary for you to rent that property. You're gonna get depreciation. If you get depreciation and then you sell the property, you're gonna have a depreciation recapture. If you don't wanna pay any tax, you can do a 1031 exchange. But alternatively, you can use the swap and drop strategy. Alternatively, you can just leave it to your descendants with the stepped up basis. Now, again, this is where all comes together. Now, here's the thing. If you have a paper loss, which again, this is what we want. This is gonna be the goal when you're preparing your taxes. You want to have a paper loss, but a real gain. Rentals in nature are going to be considered passive income. And what this means, it's subject to the passive income rules and passive losses rules. So if you have losses, passive losses in this instance, then your losses are going to be limited to $3,000. So in the first example I gave above, the depreciation was higher than the income for that rental property. What that means is you actually get to use the difference in depreciation towards your active income. So you're reducing the taxes you pay on your active income by having that depreciation work for you for the active income. So it's not limited to that property. However, it is limited to $3,000 a year. And what this means is you can only use $3,000 depreciation in excess of your net income towards your active income. I know that was a lot of words, but now if you want to use all of your depreciation, let's just say you had a $10,000 loss, paper loss of course, that you want to use against your active income from your W-2 job, then you gotta be a real estate professional and you gotta materially participate. That's why I was talking about those concepts before. Because when you're a real estate professional, basically you're telling the IRS, hey, this is not a passive activity for me. This is actually an active activity. I'm a real estate professional. This is what I do. This is my job. And so this is active income for me. And in that instance, you actually get all the depreciation, all of your losses in your properties, and apply it against your active income and reduce your taxes that way. Now, let's say you have actually income even after depreciation. Well, if you're a passive investor, then you have a benefit because you actually don't get to pay self-employment taxes. If this was to be a business, you would have paid about 15% self-employment taxes on that net income after depreciation. However, if you're a real estate professional, you were just telling the IRS that this was active income for you. So then, yes, you would pay that 15% self-employment tax. Again, this is a lot. These are a lot of concepts, a lot of new concepts for a lot of people. So now let's give again another summary of the rental treatment for long-term rentals. First, you get the deductions for expenses that you incurred for running the property: insurance, property taxes, repairs, software, meals, mileage. You're gonna get depreciation every year you're running the property as a rental. If you sell, you're gonna get a depreciation recapture tax. If you don't wanna pay any tax when you're selling, you can 1031 exchange into another property. But now, if you just wait long enough, your descendants could inherit this property at a stepped up basis. Now, if you have a paper loss and you're not a real estate professional, that paper loss, it's limited to $3,000 a year towards your active income. If you are a real estate professional, you can deduct 100% of your paper losses against your active income. Now, if you have income and you're not a real estate professional that does not materially participate, you will not pay self-employment taxes. Now, if you're a real estate professional and have material participation, you would pay self-employment taxes on this net income. So now we just talked about long-term rentals. Now let's talk about short-term rentals. This is a very popular topic because of Airbnb, VRBO. People want to rent by the room on their own properties. And so it's just going to be a little bit different. So I want to introduce another concept, and this is the substantial services concept. And basically, I like to think about this like a hotel. They come in every day to clean your room. They give you breakfast every day. They sometimes have a concierge that's going to tell you the events that are going around. These are substantial services that are just different from like, hey, here are the keys, and like after you leave, I'm going to have the cleaning crew come in. It's going to have different tax treatments for that. And the other thing is that a lot of people, they believe that short-term rentals are just less than 30 days, but for tax purposes, it's actually 6 days or less, or less than 7 days. Because the thing is, a lot of people have this misconception because a lot of the regulations for short-term rentals are based on 30-day stays, but for taxes, again, 6 days or less. Now, there's this person, Mark J. Kohler. In his blog, he created this beautiful matrix. We're going to go through it and we're going to talk about the different tax implications for each of them. Now, here's the matrix, and as you can tell, there's a lot of things going on. So we're going to discern this in great detail. So first of all, we're going to have the substantial services at the top, less than 7-day average on the left. Now, if you're providing substantial services, again, like a hotel, for your guests, and the average length of stay is less than 7 days, and you have material participation, then you are going to pay self-employment tax if you make money on that property, even after depreciation. However, if you do have losses, they're going to be active losses, and you can offset your active income against such losses. Now, in the same instance, if you are providing substantial services, but the average length of stay is more than 7 days, and you don't have material participation, then you are going to pay self-employment tax, but it's still going to be a passive activity. And this is what he calls the worst of all worlds, because if you make money, you're going to pay self-employment tax. This is a business. However, if you have losses, they're still going to be passive because you don't have material participation. But now most people are not going to provide substantial services, and they're going to provide material participation like we talked before. So talking about this, if your length of stay, your average length of stay, it's less than 7 days, you don't provide substantial services, but you do have material participation. Now, in this instance, you're going to get the best of both worlds, because if you do make money, you're not going to pay self-employment tax. However, if you have losses, you actually can get pass-through losses against your active income. But now, if you don't provide substantial services, now, as you can tell, there's a lot of ways of navigating the tax code, a lot of ways that are going to have different advantages and disadvantages. You need to work with someone who understands all of these. And let me just give you an example. Let's say you want an Airbnb, you want to increase your bookings, so then you start offering substantial services. You want to give tours to your guests. What happens is maybe you did increase your bookings, but now it bumps you into a different tax category and it ends up costing you way more money because now you're paying other kinds of taxes. But now it could also be the opposite way. What if you want a mountain cabin? You don't really care about having a tax loss. In fact, it is preferred. Then maybe you want to have substantial services. Maybe you want to have losses that offsets your active income. You were just going to use that as a second home anyways. You might as well have the property work for you in a way that's going to give you the best long-term results as it relates to tax benefits. There's ways to be doing this, and you really got to work with someone who understands these. And if you just heard what I said, the same reason why someone might want to provide substantial services is the same reason why other people won't. That's why it's so important that you guys call me, because we first have to figure out, what are your goals? What is it that you're trying to achieve? Do you want to have a second home and have tax write-offs? Or do you want to make money on your Airbnb and not be taxed to death? And I know in this video there was a lot of information, and you're probably going to have to rewatch it many times if you're going to want to use it for your purposes of investing. But when it comes to investing, it all comes to this. Now, I know this is a lot of information, but it all comes down to this. If you give me the ability of making a 10% return on a stock or a bond, or 10% return in real estate, I'm gonna take real estate 100% of the times. By having the principal be paid down, we're also gonna have all the tax benefits, and there's also potential for appreciation. And when you add the compound effect of having all of the tax benefits along with the loan pay down, that 10% return can be way greater, and it just compounds every single year. And just as a last note, the one thing I like about all of these different tax strategies is that you can mix and match. And this is going to be a little bit more complicated, but just to give you an example, remember when you're living and flipping a home, you're going to have a tax-free gain of up to $500,000 if you're married. Well, what if you combine that strategy? Remember, you have to live there 2 out of the last 5 years in the property to qualify for that. But what if you qualify that strategy with the long-term rental, whereas you live in it 2 years, you flipped it yourself, you have a ton of unrealized gain on that property, then you rent it for 3 years, you take the depreciation in that instance. When you come to sell it, you're just gonna pay the recapture on the depreciation that you took. So now any other gain on top of that is going to be tax-free up to $500,000. So in that instance, you can literally make hundreds of thousands of dollars and pay zero tax. Or in another instance, maybe you have a rental in Denver, you want to move into the mountains in the future, you want to retire. Well, of course, you got to be reasonable with the timings, and basically there are some certain guidelines, but you could sell the rental here, then you buy a condo in the mountains, 1031 exchange into it. You leave the condo as an investment property for a certain amount of years. I can't remember exactly how many. And then a few years later, then you can move into that property. It becomes your primary residence. And then you swap until you drop, and your descendants get it with the stepped up basis. So in that instance, you use a 1031 exchange and you use the swap and drop strategy, and you had a vacation home, and during that time you could have it as a short-term rental with material participation, all of these concepts, whereas it gives you tax benefits every year. It's just incredible, all of the different possibilities that you can do, as long as you know what your goals are, where you want to go. You talk to me and we're gonna get you there. The same reason why you might not want to do a certain thing might be the very same reason why someone else wants. And that's why this gotta be a tailored advice just for you. Now there's a lot of tax strategies that you can use, and I get it, this can be very complicated, but of course when you're moving here you gotta reach out. We're gonna find the best option for you. Our job with this channel is giving you an honest opinion of what's like living in Denver, Colorado and the surrounding areas. So right now, hit the subscribe button. We do videos every week. They're the most in-depth videos about living in Denver, Colorado and the surrounding areas. And also drop a comment down below what areas you want to see next, or if you have any question. I'm always here, happy to help. Until next time, see you later.